All right, so welcome. Today, we're really privileged to be speaking to Dr. Bob Murphy. Dr. Murphy has a lot of different experiences in both academia and the private sector. He's a former professor at Texas Tech and the Free Market Institute, co-founder with the Nelson Nash Institute with Carlos Lara, a senior fellow at the Mises Institute, and host of the Bob Murphy Show and the Human Action podcast. More recently, he's been doing work trying to integrate new technologies with the concept of infinite banking and blockchain technologies. So we're just really thrilled and privileged and excited to have Dr. Murphy on our show. With that, I wanted to turn it over to you, Dr. Murphy, and give you a chance to kind of see if I messed up anything or if there's anything you want to add, feel free to do so.
Oh, well, sure. Thanks for having me, guys. Glad to be here. Yeah, it's everything you said was accurate, and just more generally, probably the way to crystallize what I've been doing with my adult career basically is trying to explain economics to the layperson. A lot of times I'll have people come up to me after I give a talk and say, "Oh, wow, that made a lot more sense than what I learned in college." And so, I take whether that's praising me or just criticizing the existing profession, either way, I'll take it. And my research specialties have been on money and banking. And so that obviously flows into the stuff that you guys are into, the infinite banking concept. And I will just say on that point, it's amazing still just how little people understand the mechanics of cash value life insurance. That when I first got into this stuff, I literally didn't know how a whole life policy even worked. And so, that was a big learning curve. But once you understand it, then it makes a lot of sense.
Bob, as you know, I've been tinkering with the infinite banking concept since 1997 when I first met Nelson. And, in the beginning, it was really difficult because think about what was going on in 1997. It was just a rite of passage to get 20% in the stock market in the 90s. And to bring up the idea of putting money in cash value life insurance, which at the time was probably had an internal ROR of maybe 5.5% to 6%. People would look at you like you were crazy to even suggest that would even be a possibility. And so a lot of folks have said to me, well, geez, Tim, that must have been great. There wasn't a lot of competition. Well, there's still not a lot of competition. But I think the difference is that people have been a little bloodied and beaten up a little by the market or just finances in general. And so the reason I say all this is, what do you think the solution is to get this to be more mainstream, to get the infinite banking concept to be more mainstream?
Okay, well, great question. And I think you're right, just to echo your sentiments there, that I can't remember the exact quote, but somebody, I remember one time said something along the lines of like, the reason these boom bust cycles keep happening is that, every 20 years or so, there's a fresh crop of people who are on Wall Street that never lived through the last one. And so that's why it just is always takes them by surprise. Whereas, the older people, and I saw that even like the housing bubble, in the mid 2000s, that I was so this was right around, what was this, 2008, I think is when, and so, things were collapsing. And then I happened to be at a dinner party and the guy who literally built my house was at this party. And he was explaining, he was an older guy and how he said he had seen the bubble coming and he just got out, wound down his business and his inventory. And then we were outside and he's pointing at a half-finished house that was literally across the street from mine. And he was like, yeah, that kid's throwing that. They were like in their 20s and they were just throwing up houses all over town, making money hand over fist. They couldn't believe how good, but he said he recognized, yeah, this is a bubble, but they had never lived through that. So I think you're right that there is this element that as people get older and they experience these things, then they get more cautious and realize, oh yeah, I'd rather have my portfolio concentrated in things that have nice, stable return, but not, something out of line that I don't think is sustainable. So I think that's an element. Also, what's funny too, when you were just mentioning all that, nowadays to hear, oh yeah, return of 5.5%, 6%, that sounds really good given how low interest rates, had been. Whereas you're right, in the late 90s, that was like, oh geez, that's terrible. What are you doing? You're just treading water. But to answer your more fundamental question, it's a cliche, but I think part of it really is just education. And I know, like, for myself, when I got into this stuff and I read Nelson's book, and I thought, oh, wow, it's a great guy to have a beer with or something. And I've said this before, when he was with us in front of him. So he thought this was hilarious. And I said, there's like 6 things wrong with this book, but it's, great guy, but no, I can't get behind this. And then I would read it more, learn more about how whole life works. Like, oh, that one part, now I get still 5 really wrong things with this. And then it just kept going down and down. And then 6 months later, I said, how come everyone's not doing this? This is so obvious, right? So that's, part of the issue. And then the other thing that I did in my due diligence was, and I do this in general, that if I'm getting into an area and I'm listening to some people, particularly if it's like my quote buddies are introducing me to something that I'm not familiar with. So in this case, like, yeah, I had met Carlos and we bonded over Austrian economics, and then he gives me Nelson's book. So I was predisposed, to want to believe. But what I do just to protect myself is I go and say, let me find the best critics. And I went scouring, and the people like Dave Ramsey and those, it was just, I found it wasn't just like, oh, okay, yeah, so there's pros and cons. It was what the stuff the critics were saying about how whole life worked was just demonstrably false. Like, it was just goofy. It wasn't even a good critique. So that also encouraged me. So all of that's to say is, again, I know it's a cliche, but I think education is going to help. But also, I think too that is more, how can I put it? There's a sort of thing where when big institutions and quote rich people are doing something, that sort of blesses it regardless of the fundamentals. And so, that you can say that's a good thing or it's a bad thing, but I think it's a true statement. And so over time, just as I've been in this space for longer and longer periods, I'm realizing that more people are catching on to this, that it's not as hard now for me. And maybe I'm curious if you guys have had the same experience. If I start talking about the virtues of cash value life insurance now, more people will get what I'm saying. Whereas 10 years ago, they were just like, their head would snap back. Like, what are you, crazy?
I agree 100%, Bob. So the evolution is, I've been in the insurance business for 40 years. Mm-hmm. And it was always a difficult conversation to have with folks because they were so predisposed that the market is the be all and the end all. And I'm not saying don't have any money in the market, but what I'm saying is there's some validation to having money that isn't correlated to the market,
right,
and having access to capital. And I think that's the biggest issue, right? I think infinite banking gives you the ability to have access to capital when you need it most, whether it's for a financial emergency, a medical emergency, or for an opportunity. And that's the thing that a lot of folks really can't wrap their arms around. And I'd like to see what your thoughts are on that subject.
Yeah. So I'll say it this way, or I'll go down this path. And I know there are some people in the IBC community that they think this is too wishy-washy. No, that you're not like showcasing how much it really stands apart. But for what it's worth, certainly if I'm talking to people who have a background in like conventional, finance and things like that, or other economists, heaven forbid, that a way that I can get this point across that I think dovetails what you're saying there, Tim, is to just look at cash value life insurance as an asset class. And just say, like, it's up, like, let's compare its attributes with, real estate and gold and, the stock market and corporate bonds and things like this. And I do Bitcoin too. And not to just like say, oh yes, this is the silver bullet, but just to show, yeah, it's got pros and cons, and you do it like that. And this is something that you guys, I'm sure you saw that, Carlos Lara used to do years ago, talking about, telling clients, come up with the perfect investment and start listing its attributes. And then they would unwittingly end up describing, 95% of what whole life insurance was. Right. So that's a thing too, that I have found is effective. And like you're saying, so to me, it's real simple to talk even to like an institutional money manager. And I have found a few of them in places I wasn't expecting, that this guy that I knew for other reasons And he was a big high, guy. He was a super math guy and everything, managing billions of dollars, and he had, put options on the S&P 500, all this, highfalutin stuff. And I mentioned, and then he said, "Oh, I saw, I was Googling around and I saw you're into infinite banking. I do that too." And I was stunned just because, he was so into, cutting edge things that I would have thought maybe this would be too, but no, he loved it, thought it was great. So my point is that, yeah, for people, it's to say this will augment your portfolio and you want to have some of this in the mix for all these reasons, because in certain scenarios, this is the best thing to have, or this can do things for you that your other types of investments can't. To me, that's a real simple case to make. Now, again, some of the more purist IBC people who want to make, push it stronger, it would be harder to make that. I'm not even saying they're wrong, but I'm just saying, but yeah, if you just want to say to somebody, you should have one or more of these policies in the mix of what you do, to me, that's a really straightforward case.
One of the things that we run into a lot of is, well, one of the things I want to sort of circle back to, Bob, is your study in money and banking and finance, and how that sort of dovetailed into sort of coming up with, or coming to the realization that infinite banking was a good solution for that as well. Can you speak to that?
Sure. So I could just retell the story. And this, we told the book that I co-authored with Carlos Lara on how privatized banking really worked. I think we told this story in the beginning of that. But yeah, it happened quite naturally that I was going around with the Austrian economists, and just to be clear for your listeners, to not confuse them, there are some self-described Austrian economists who have no problem with fractional reserve banking, but the ones particularly who call themselves Rothbardians, it's sort of like with Christianity, there's various sects, and the people you can't stand the most agree with you on 99.9%. So it's like that in economics too. But in any event, the people who adhere to the particular variant of Austrian economics in the tradition of Murray Rothbard think that fractional reserve banking is, perhaps outright illegitimate, or at the very least is destabilizing, and is what causes the business cycle, right? And so, and I was going around doing PowerPoint presentations after the 2008 crisis, talking to crowds about, here's what happened. The Fed came in and they were, pumping in money that didn't correspond to genuine savings, and blew up the housing bubble and all this stuff. And now with the QE, they're doing it again, and we need to return to sound money. And then again, through Carlos, I got into Red Nelson's book, and then I had become a proponent of IBC, but I still initially was thinking these were two distinct things. Sort of like, I like sushi and I like playing basketball, but the two have nothing to do with each other. Like, to me, it was, I don't like fractional reserve. And then Carlos, had the insight to say the more and more households and business owners that practice IBC, that's in a sense 100% reserve banking, right? Because the insurance carrier, they can't give you a policy loan unless they have the money first, right? Whereas a commercial bank, when they give you a loan, there's a sense in which they're creating that money. Now, yeah, they have reserves, and there's regulations and things like, well, actually, the Fed got rid of the regulations on that. There's zero reserve requirements now, but you get the point that it's not like you just do whatever they want, but there really is, both legally and economically speaking, a qualitative difference between you taking a loan from the insurance company versus the commercial bank. And that the latter is inflationary and causes the business cycle in the way that, the Austrians described. And so that was kind of what unified it, and sort of brought together my two worlds there. And so it did feel like, oh yeah, so now as I'm going around, telling people, educating them on how whole life insurance works, and you can use this as a solution for your household or your business, that all dovetailed quite nicely with sort of the macro thing that I was telling people in general about, here's the direction of the country.
That's actually kind of an interesting point, because especially coming from the Austrian economics background, I was involved with a lot of the Mises Institute stuff early on, but I had never heard about IBC until I met my wife, and she's a big fan of yours and listener of yours, and she had been exposed to it. And she was like, "Hey, you should check this out. Like, Dr. Murphy has done like a lot of cool stuff with this." I was like, "Oh, this is really neat." Like, and that was my first kind of exposure to IBC. So, I guess with saying that, what are some of the things that sort of inform your view of IBC as a tool for financial independence? And would you start trying to pitch IBC on the basis of Austrian economics or some other practical point?
Okay. So for one thing, I should probably just say this at some point that, so I am no longer formally with the Nelson Nash Institute. So I use a broader term like just, whole life insurance or things like that, just for product differentiation to not confuse people. So, but yes, I still believe in IBC. So yes, to answer your question, I still definitely think I'm doing a lot on the economics of life insurance. For example, I have a white paper where I've studied, it's called the Sharpe ratio, which is like risk adjusted returns. It's kind of like you have a benchmark, call it the 3-month treasury or 5-year treasury, depending on the situation or the application. And then you look at the assets and see how much do they outperform that. But then you divide by the volatility of the returns, right? So the idea is, you want to outperform the benchmark, but also have stable returns. And I looked at, curated whole life policies, ones that had been in force for like 10 years plus, those versus, gold, Bitcoin, real estate, the stock market, AAA corporate bonds, and so forth. And I think a few others as well. What do you call it? Case-Shiller, home price index. And the whole life policies blew those other ones out of the water. Like it wasn't even close, right? So yes, that I'm going around to, like I say, institutional money managers and trying to get them to see that, hey, you're sitting on various things and you've got a bunch of treasuries like sitting in your portfolio is the quote safe asset. Well, over the long run, whole life policies are going to have a higher appreciation and they're actually more stable in the sense of the, volatility and whatnot and the predictability of those returns. And, so you could say they're not as liquid. That's like the downside, but the default risk is also pretty low. It's not like the carriers are going to fail probably. Right. So anyway, I'm just saying that if I'm answering your question that, I can all day long go around and tell people about the virtues of whole life policies is a great asset to have in your mix. And I think a lot of it is just people don't understand. Just to give you one example, like I was talking to somebody and she was very savvy in the financial sector and also very into like alternative assets and things. So she wasn't someone who just parroted the line. Like it was like, actually, she was a bit of a contrarian. And when I started talking about whole life insurance, she was like, oh, but doesn't it have like a return of like 2% or something? Right. And so she had absorbed some of the, the critics' views where, I don't even know where I guess it's like, if you surrender the policy 4 years into it or something, maybe that's where they're getting those numbers from. But anyway, I'm just saying, there's still, even among people that know a lot of things beyond just what you'd go from going to investing.com or something, that still there's a lot of education that needs to be done on this topic. And in terms of particularly if it's like a business owner who has a lot of cash coming and going, the virtues of having this asset where, just explaining in general, you get the virtue, right, of having an asset that you can borrow against, like Warren Buffett does that. All these people do that. They understand the advantages of that. And when every time it comes up with the, impetus to reform the tax code and the progressive Democrats get so mad about these rich people paying themselves $1 in salary and how all that works, and just say, okay, right. Yeah. So that's what rich people do. And now here's an asset where you're guaranteed. You don't have to prove, you have to go to the bank and prove the kind of collateral it is. It's contractually built in that you can borrow against it. So those are some of the things that, I stress when I'm talking to people. And once you kind of unlock it, then they, again, a lot of times they're just like, how come nobody told me this before? This is amazing.
Yeah, I think one of the key critiques that I've heard a lot, and I know I've heard you address this before, but I'd be kind of curious to have you rehash this a little bit here, if you would, that with sort of the inflationary pressures that we're starting to see, that, $100,000 policy, that's great, but in, 50 years, that's not going to be worth anything. So how would you kind of rebut that in terms of like better investments or something along those lines?
Well, sure. And that's partly why I was saying that to me, it's a slam dunk just to say this should be one quiver in your, one arrow in your quiver, not a quiver in your arrow. You wouldn't be able to get it in there, but one arrow in your quiver that, if you're very concerned that the dollar's going to crash next Thursday, you don't want 100% of your portfolio in bonds or you don't even want it in just pure, whole life policies, because you're definitely, those are going to be paid off. It's going to be easy for the carrier to make those payments, when you die, or, if you surrender the policy or want to borrow against it. But yeah, it won't buy you as much as you probably thought when you took the thing out. However, having said that, that's not a reason to not do it, right? And this is something that I think I understand why the people who hesitate and say, don't just call it like a separate asset, because, Nelson used to stress this is not an investment. His point was, this is a financing vehicle. This is a way to go ahead and buy your other investments, just to, run your cash through these policies. And just to illustrate his philosophy with your particular example here, Gordon. So, right, if someone's saying to me, no, I'm really worried about the dollar crashing, and so don't I want to have gold or Bitcoin or silver or, real estate in Australia or something? And you say yes, and that's not a reason to refrain from, doing IBC. You can go ahead and set your policy up and everything. And then when it's up and running, you've got your infrastructure and you wanted to buy $50,000 worth of gold, you can still go ahead and do that. And you take out a policy loan and go ahead and do it. And, so that's kind of the way that it's not tying your hands. Whereas if you put your money into a 401k or something, depending on your age and everything, then you might not be able to pivot and then buy gold when, the signs are right, because, now it's locked up and you're going to at least pay big penalties to take it out early. Right. So I think that's part of the issue, that yes, be aware of the fact that it is a dollar denominated asset, but also, you do have that flexibility. So it's not forcing you to just put your quote money in life insurance and let it sit there. The other thing I'll say too is, depending on what you think's coming, there is an inbuilt adjustment mechanism, right? So yeah, if it's just a one shot, the dollar depreciates 90%. Okay, that would be a shock. But if it's more that, regular consumer price inflation is going to be 5% or 7% for the next 30 years rather than 3, you would see that the dividends would end up being higher than you thought originally, right? So that there is a way that, long-term bond yields would rise because of the higher price inflation. And so that would feed into the policies, the dividend payouts with a lag somewhat. So it's not that it's just black or white and that it's totally awful in an inflationary environment. But yeah, there would be that lag crossover period up front. But again, if that's what you're worried about, go ahead and get your inflation hedges in place. That practicing IBC is not stopping you from doing that.
Well, and I also think the real benefit here is you can always let the policy lapse, right? If inflationary pressures get too intense, right? So that's always been kind of my vision of it, is that you could always switch into another asset if you need to. But
yeah, I mean, in fairness, like, you wouldn't have wanted to just set up a policy 18 months ago and then surrender the whole thing. You know what I mean? Like but you're right. If it's the kind of thing where this is a long-term plan, ultimately, yes, once you're above water, there's nothing stopping you from switching over. But even there, I mean, you're not incorrect, Gore, but I would just say in almost every circumstance I could think of, it would be better to take a policy loan out and, use the money that way rather than, surrendering the policy. But yeah, you could in principle do that too.
One of the things that I always share with folks when we're setting up policies, especially people in their 30s and 40s, is that as an advisor, my job is to help you make decisions today that your future self will be happy you made.
Mm-hmm.
And one of the things I share with them is the fact that whole life insurance will probably be one of the best assets you own in your 60s. But the catch is you got to buy it in your 40s.
Yeah.
And a lot of people don't have, unfortunately, in today's times, people don't have the patience to wait that out. And where infinite banking fits is that, well, now you could access that cash value early on and use that to take care of, any debt issues you have, make purchases, and make investments through the vehicle of whole life insurance.
Yeah, it's funny. This isn't exactly what related to what you said, but it reminded me that a thing I would encounter. So to be clear, just to not confuse your listeners, like I was never in the actual production of sales, right? Like I was always advising people and doing analysis and things, but I would still encounter a lot of on the, man on the street kind of reactions. And it's funny, a lot of times if you're explaining this to a younger person, they would say, oh yeah, this makes a lot of sense if you're rich, but right now, I'm just struggling to make ends meet, so I just need to get a term policy or whatever. And then if you said it to people who are like in their 60s, like you're saying, they have tons of assets, they would say, oh yeah, this would make sense if I were young, but now, so it's kind of like everybody said, I would have done this if you had caught me at a different stage of my life. And it's actually the other way around. That so it's true, the correct policy design is probably different depending on the person's circumstances, and somebody who's real young, that they might need a supplemental term rider or something, because in case they get hit and they got to pay the mortgage off. Whereas somebody who's older, maybe you want to move a bunch of money in up front, that kind of thing. But in any event, you're right that it does give you that flexibility. And I will say too, again, not that I was directly involved in the cases, but being familiar with lots of IBC practitioners and seeing case studies and things, it always was amazing that, put it this way, that when I would talk about the virtues of whole life insurance and how you could use it as a cash flow management vehicle, things like that, some of my more savvy, trained, guys in the finance and economics fields, they would come up with these scenarios where, oh, well, instead of doing that, couldn't you instead have a synthetic asset and blah, blah, and they would do some other strategy that would mimic this and whatever. And I say, sure. But when it comes down, when you see what people in the world right now are actually doing and how they're, running up credit card debt and they're doing this and that, and then coming in and, oh, wait a minute, what if you got one of these policies and just did this? That makes so much more sense than what they're actually doing right now. Okay, you know what I mean? So in other words, it was like these people were trying to veto the IBC approach because they could dream up some alternate thing. Whereas like, no, people doing the IBC approach to get out of this other debt that's rolling over at way higher APRs than what the carrier charges on a policy loan makes way more sense. And then once you throw in like the psychological element too, then it really shows, how it could make sense. Like you say, you find someone, they got a mix of assets and debt, and then they start taking out a policy and fund it and borrow it and knock the debt out. There is a certain sense in which you could say, well, couldn't I have done all that without running it through the policy? And yeah, maybe, but having the policy there is also very, reassuring psychologically too, that in case you died, you do have this extra death benefit that comes in and cleans up everything. So,
Bob, you had alluded to, and thanks for clearing that up, but you had alluded to earlier the proper policy design, which I think is a tremendous segue into indexed universal life. Could you talk about sort of the mechanics of the IULs versus whole life, and why whole life is, for, from Nelson's perspective, was the best type of policy to practice infinite banking with?
Yeah, sure. So a few things. So in general, the difference between like whole life and universal life, I'm going to brush with broad strokes here, but it's that the UL had the safeties off. It was more like it was putting the risk back on the consumer, whereas the whole life, generally speaking, it was the guarantees were all on the side of the consumer, and then if things didn't go as planned, it was the carrier that was going to eat it. Okay, so in terms of having a stable asset that was going to grow dependably over time, that you could, quote, bank on, right? That was going to serve as the foundation of your cash flow management. It wasn't a literal bank, regulators, but, something to serve as a management for cash coming in and going out. That what you wanted was dependability and predictability. It was not that, you so much cared about, oh, I want to get a higher rate of return, but I'm not sure if it's going to be there or not. Right. So that was the element. And then Nelson, talked about how when UL came on the scene and, there are all these horror stories about, oh, if interest rates are doing really well, then you can just underfund the policy. And so again, giving more options, that's kind of what the term universal, hey, you can do whatever you want with it. Hey, if you want to pay lower premiums, go ahead. That's fine. Just dial it down and that kind of thing. When you pay the mortgage off, you can dial down the death benefit, right? So that was the virtue. And if you read like a life insurance textbook, when they get to the UL part, that's how they'll explain it in the the virtues of it, or why somebody might like that versus whereas whole life is more cut and dry and this is what you bought and that's what you got. But again, the downside of that is if you're not watching it carefully, then yeah, it could, if when the cost of insurance goes up over time, it just eats into the cash value. Whereas with the whole life, as long as you make your premium payments, according to what the contract said, you're getting at least the guaranteed cash increments. And then, as they issue dividends that they typically do, you get more on top of that, right? So you can just put it in the drawer and forget about it if you wanted to. I mean, you still could do IBC, obviously, but it's going to be there and you know what it's going to do. So that's in terms of something to build your banking system upon. You want that dependable thing. And so then if that's just standard UL, then all the more so something like IUL, if it's like indexed to the stock market. I mean, behind the scenes, what's going on is they're taking some of the cash and they're like buying call options on the market, right? So that's how it's capable of. It gives you some of the upside, but none of the downside, right? So it's not that they're going and buying stocks on your behalf. It's instead they're buying things that, if the market goes up, it hits. If it doesn't, then they're just out the cost of the options, right? So that's kind of how it mechanically they manage it behind the scenes. But again, the point there, you're kind of missing the whole point, right? Again, because Nelson's stressing IBC is not investing in life insurance, right? It's not that, oh, look at the rate of return I can get here. You're missing the point. If you want to invest in the stock, it kind of back to Gordon's point too. If you want to invest in the stock market, Nelson's not saying, no, you can't do that, you naughty boy. Go ahead and do it. But the point is, don't blend that with, the life insurance element. That what you would do, you can do IBC with a whole life policy. You know exactly what the rules are going to be and how it's going to march up over time. And then, if you think the rate of return in the stock market is going to be higher than the policy loan interest rate, it might make sense to borrow against the policy and then throw that in the stock market. And if it keeps, in general, you might make the arbitrage spread. Okay, good. That's great. But the point is, how the life insurance policy is going to perform, as that solid foundation. And then the market's doing its thing over on the side. So I think, that's the way that I would explain it. And I think that's consistent, so for sure, just to be clear, Nelson unequivocally said, if you're going to do IBC, like there were some things he didn't get all bent out of shape about that, some of the agents, the people like his disciples, if you want to use that term, would argue about that he didn't, like direct or non-direct recognition, certain things that, people have strong opinions in the IBC community, but Nelson wouldn't really, bless one and denounce the other. But he was very clear. If you're going to do IBC in the way I'm talking about, the chassis has to be a whole life policy. It can't be, an IUL or something.
Yeah, and I think if I remember correctly, there's an example in the Becoming Your Own Banker book too, where he breaks down that precise objection and shows if you take it out of the policy loan and then make the investment, the end returns and like what you finally end up with is higher than what you would have outside of just investing something out of your savings account or something like that.
There's two things going on. So one of them is like with the car financing or something. And I don't know if that's what you're talking about, where like he shows different strategies and one is like, if someone just leases, okay, or someone just borrows, but then even with the people saving, like one person's just doing a sinking fund with bank CDs versus whole life. And I think part of how that works is that the internal growth in the cash value with the dividends is higher on the whole life policy than what the bank's paying. And that's why you end up with more. But you're right. Then there's another part too, where he's talking about investments. And that one, just to caution people, I think in that particular example, he was assuming you could deduct the interest on the loan to get like that was really juicing the outcome there, which was correct when Nelson originally, did that. But then I think they did change something with the tax treatment. So just to warn people on that part.
Yeah, for sure. Gordon, was there something you wanted to ask Dr. Murphy?
Yeah, well, I wanted to make sure we had some time to kind of talk through some of your more recent work with Infinio and some of the new things you're doing with blockchain technologies. And if I'm not mistaken, you've done some stuff with AI as well.
Yeah.
So could you tell us a little bit about that? What are some of the new things? What are some of the horizons you see for whole life insurance and where you and your colleagues are taking it, and how do you see this sort of evolving or developing into the future?
Well, sure. So with all this stuff, I'll just point people to Infinio.ai to get the full story on this, but I'll just give some teasers here. That yeah, the elevator pitch of what are you guys doing over at Infinio is we're taking life insurance and putting it on the blockchain. Okay, and so this was the vision of Cole Snell, was the founder of Infinio, and he was a graduate of the Nelson Nash Institute practitioner program. So he understood how IBC worked. He was also a fan of Bitcoin, which used blockchain technology. Okay, so just to be clear for people, Bitcoin and blockchain are separate things. Blockchain is like the technology that you use to move the Bitcoins around, if you will. And so he was trying to think of a way to merge those two, to get the conservatism and the dependability of this centuries-old financial product, namely whole life insurance, with the cutting-edge speed and versatility and other conveniences of blockchain technology. And so that was the genesis of Infinio. And so at this point, we already have, just to give one example, we have this thing called the ledger, where the user can take their conventional, paper policy. If they have a PDF of an illustration, they can upload it to our system, and then with their permission, they got to consent to everything. But then our system creates like a digital twin, if you will, of that policy that lives on the blockchain. Okay, so the process is called tokenizing it. So right now, so that's there. We have over $500 million of that already done. One of the things in terms of why would I want to do this that we have right now, we're building in more functionality as we speak. But one of the things right now, just out of the gate, is if you want, you can program in the details. So the system periodically checks in with the insured. If the system comes to think that, oh wait, the person's not with us anymore, it goes through some different checks. And then when it thinks it's appropriate, sends out notifications to the beneficiaries, giving them the information, like here's the carrier, the policy number, how to claim it, so that you're not looking for Uncle Frank's policy in his drawers while you're planning the funeral, like that kind of thing. Just again, this is all you agree to it on the front end. That if you wanted to do that, then you can set that thing up. But ultimately, to answer your question, Gordon, we're training. We call it AI Bob, right? So and people can see it right now if they go to infinio.a and go you can see it if you go to the ledger. But it's a little pop up, and it's an AI system it's trained in general on the internet, like these things always are. But it also has been augmented with my writings on life insurance specifically. I've written white papers and things for Infinio about how does this stuff work. So the ultimate vision is when you upload your policy and sync it with our ecosystem, you can ask the AI things like, hey, I want to have $50,000 available for this purchase on this date. What do I need to be doing with my, paid up addition rider, that kind of thing. And it can go ahead because it's got your policy in there and it knows how to analyze it and give you feedback and stuff like that. So that's, just one of the directions we're taking this. But more generally, and this is kind of what I was getting at earlier, is that what I'm finding in conversations, there's people going around tokenizing everything. They're tokenizing treasuries, gold, real estate. And so it's making it easier for certain institutional money managers to hold different types of assets that traditionally are a bit cumbersome. And so that's why I thought whole life insurance is the best candidate for this process, because as you guys know, and we just talked about earlier, there are many reasons that whole life as an asset is superior to a lot of the other traditional ones. But as reasons you can't, as an owner, just like say, oh yeah, let me reduce my exposure to bonds and increase it to whole life insurance, right? There's a lot of friction involved. The policies are heterogeneous. It's, you got to have certain licenses to even work in that market if it's the original first layer, things like that. So that's what we're trying to get to the point of, is that if we can have a pool of these policies that have economically the same, like tokens that point back to them, and then people can move those tokens around, that's mimicking a lot of the economic or financial performance of the original policies, without having to actually, transfer physical policies around. So that's just a couple of examples of the stuff that we're working on in Infinio.
Yeah, I'm a big proponent of AI and blockchain. Love that stuff, and it's just really exciting to hear that y'all are figuring out ways to integrate some of those technologies. On a somewhat of a similar note, I was just thinking back to some of my recent questions about the policies being denominated in U.S. dollars. I just saw a headline the other day that Missouri legalized legalized gold and silver as an option for legal tender. Do you ever see a possibility where we might develop life insurance policies in terms of gold or silver or even Bitcoin or something along those lines?
Yeah, sure. There are companies out there doing the Bitcoin version for sure. And so to be clear, I'm glad you brought that up. So what we're doing in Infinio, we're taking conventional
Right.
US dollar based policies and putting them on the blockchain, right? So I'm glad you brought that up because yes, I know there are other companies that are at least dabbling in the idea of what if your policy was itself denominated in Bitcoins. Right now, I think there's issues with it, like, because what do you do for the yield? You know what I mean? Whereas right now, like, yeah, if you give me $100,000, I can credibly promise to give you a higher amount in the future because there's an established bond market in dollars. Whereas somebody gives me 100 Bitcoins today, how can I promise to give you 500 Bitcoins when you die? That kind of thing. It's not as obvious.
Gotcha.
But in any event, I'm just put that to the side. Yes, I understand what you're saying, and that is certainly is something for the future. I have been dabbling theoretically with the idea of could you have a gold, a gold denominated life insurance policy, and how would that look? And and I have contacts coming from the Austro libertarian world. I know plenty of people in the mining space and precious metal, gold coin dealers and things like that. So at some point, it may make sense to introduce a product like that. Again, I think in general, yes, that's where the world is moving, where as this stuff gets more and more blockchain based and everything turns more and more digital, that at some point, put it to you this way, right now, for people who dabble in, or not even dabble, people who move large amounts of market value worth of cryptocurrencies around, it's easy for them to get in and out of one or the other. Okay. And if they want to like kind of park it, they put it in what's called stable coins that are like pegged to the US dollar. It's really interesting that in the beginning, people wanted to get into Bitcoin because they hated what they thought of as dirty government fiat money that's not stable or not trustworthy. But then as that industry grew, now people want to just park their money, but they didn't want to like convert it back into conventional dollars in a checking account. So now there's tokens that are tied to the US. So it's kind of funny that that's some of the biggest, in terms of market cap, are tokens that are tied to the dollar, which you would have thought, not have thought. Anyway, my point is that how they just move that around, and I think that's going to spill over. That it's going to get to the point where just the various government currencies, things are going to be coming and going, and that yes, I can imagine moving in and out of U.S. dollars or euros or yen or gold or Bitcoin or that it's just going to get a lot easier with AI, everything augmenting this stuff to move stuff around. And so yes, it would not surprise me in the future if, when you want to take out a life insurance policy, you just get a pull down menu. What currency or what asset do you want it denominated in? And it's not just the USD and euro and whatever, but also, Bitcoins or ounces of gold or whatever. That would not surprise me if that's where we're going.
Did you have any final thoughts, Tim?
No, I think we covered pretty much all or most of what I think our audience would appreciate. Understanding that, Bob, the name of our show is the name of our show is the Control Your Cash show.
Mm-hmm.
And I could never think of a better process than infinite banking that helps you to literally control your cash and your cash flow. And I'd like your thoughts on that statement.
Yeah, I agree 100%. And that is ultimately, again, coming down to just conceiving of the infinite banking concept. And it's like, oh yes, it's a method, using these whole life policies for cash flow management. That was kind of the generic description of that. That is what Nelson discovered and is describing. And then once you couch it in those terms, and you can see that, yes, it's that, the questions that Gordon was asking about, oh, what about if you're worried about inflation or things? Sure. But you still need dollars coming and going. If you're living in the United States, you still got to pay your landlord or whatever, your mortgage is going to be in dollars. You go to the grocery store, you're going to need dollars. And so whatever else you think's going on, you need to have a flow of cash, which is not the same thing as saying, wealth per se, but no, like actual cash flows. And what better vehicle to deliver that than whole life insurance policies?
I think one of the biggest issues that people is foreign to most folks is the idea that we're so conditioned or preconditioned or actually educated, maybe, or I don't want to use the word brainwash, but that's the word that's coming to me, that the only way to make money is to invest it or to deploy it somehow. And what we have come to realize is that how you're using your money is probably another way where you can be in control of more of your money. So in other words, we've been trained to cede control of our money in various, real estate investments, stock market investments, et cetera. But that money has to come from somewhere. And then, you're sort of draining down the tank in order to make that investment. But if there was a way where you didn't have to drain down the tank, a collateralized loan, now all of a sudden you're in control of more and more of your money, and you're using that money to create an external rate of return, as we always do and we've been trained to do. And I think that's a concept that more and more people are starting to come around to.
So I know.
Yeah, I think. Sorry, go ahead, Gordon.
Go ahead, Dr. Murphy. I know you have a hard cutoff at 4, so give you last word.
Yeah, sure. Just on that point, Tim. Yeah, great stuff. And Nelson, was it like the average American section or something in his book, where he goes to, and you're right that it's, we got, you got to take out your 30-year mortgage, and you got your 5-year note on the car, and you got this and that, and you got your bills and this, and you got, made credit card state. And that, it's the small sliver of what you have out of your paycheck at the end of every month that then you're going to go do something with. And what's the rate of return on that? Whereas looking at it more holistically and saying, where the heck is all my money going? That works. And that's kind of what I was alluding to earlier when I've seen particular like workout scenarios where people I know that are in this business and showing what their clients came to them with and what they ended up providing them with and a way to dig out of that. And you can say, but did you really need the life insurance? Couldn't you have done X? Okay, but what they were doing was insane. And this gave them a very straightforward way to dig out of that. And then when all was said and done, they had this cool policy that, had a big fat death benefit and a bunch of cash in it that they could then borrow against and do whatever they wanted. So, that's the kind of the scenario that we kept coming up over and over.
Fantastic. I've learned so much from you, Dr. Murphy, both from your books and listening to you on podcasts. And even today, this has been super educational for me and just a huge pleasure for me to have you on our podcast and to talk to you a little bit. So thank you so much for your time. And I wish you all the best in your adventures with Infinio.
Okay. Well, thanks for having me, guys. A pleasure to talk to you.
Bob, thank you. Take care.
Take care.